In the last 15 months, while equity market Sensex has given negative returns in 4 months and gold has given negative returns for 5 months, this technique would have given a positive return for 14 months out of the 15 months. If you have a sum of money that you want to start investing to generate a regular income, here are some ways to do it. I'll provide an optimistic view and then a very conservative option as well. First, the optimistic side. This is a strategy for investors who prefer a hands-off approach without constant research or rebalancing. This is perfect for those who enjoy lazy investing. Here is a breakdown. I'm considering 50 lakhs as an investment amount. It could be any amount. 50% of the corpus, that is 25 lakhs, is invested in debt funds, expecting to generate a return of 7% approximately, which is approximately 1.75 lakhs per year or 14,500 per month. 30% of the corpus or 15 lakhs is invested in a hybrid fund, expecting to generate a 10% return or 15 lakhs or 12,500 per month. 10 lakh rupees or 20% is invested in equity fund, which is not guaranteed, but it is likely to generate about 12% return. That is approximately 1.2 lakhs a year or 10,000 rupees a month. So the total monthly income that this portfolio could generate is approximately 37,000 per month in a balanced approach with room for growth as the equity portion appreciates. Now, many investors could get carried away by the recent rally in the equity markets, Nifty 50 having given something like a 25% return. I would suggest not to get carried away. You must have a good allocation to fixed income such as FD, Provident Fund, PPF, debt fund, arbitrage fund, and even gold. Mixing different uncorrelated assets creates an alchemy, and I can show it here. In the last 15 months, while equity market represented by Sensex has given negative returns in 4 months and gold has given negative returns for 5 months, even gilt funds have given minor negative returns for 4 months. This technique, a multi-asset portfolio, would have given a positive return for 14 months out of the 15 months. So this strategy is not about maximizing return, it is about minimizing risk, which is one key component of portfolio construction. Having fixed instruments, their value will be realized when the markets come off the peak, which it will. For the first bucket, one may consider short-term debt funds, money market funds, arbitrage funds, gilt funds if you know how to manage the duration risk, or simply dynamic bond funds or corporate bond funds. You have to be careful in the selection of these funds as it depends on the quality of bonds that they carry. Hybrid funds, one can research balance advantage fund, multi-asset funds. There are some multi-asset funds that try to offer FD-like experience. What it means is to manage it with very low volatility. Please email me here for a risk-reward details of these funds. Then there are some which are very aggressive with 50% or more average exposure to equity. One needs to select this based on his or her risk profile and needs. A multi-asset fund combines 3 assets: equity, debt, and gold. On the equity, if you're not very interested in actively managing the portfolio, you could research about flexi-cap funds or the large and mid-cap funds. Now, if you want to actively be involved, you can look at shifting money from debt into a high-risk profile equity fund at these times. This is the Bollinger Band. When the index hits the lower part of the band, you can consider topping up or shifting cash from a debt fund into the equity fund. You can use a setting of simple moving average of 50 days or 100 days with 2 standard deviations to plot this chart. Now, when it hits the lower band, do not rush thinking in that it's only going to go up from there. If you flash back, it can hit the bottom band multiple times and still keep going down. So look at investing over installments. So you have 100 rupees to top up. First go with a part of it, say 30 rupees. Then if it goes down further, another 30 rupees and then 40 rupees. If you prefer not to actively manage your investments, or if you don't have the time or expertise, then consider sticking to annual rebalancing of this. Here's how it works. If your original allocation 20% towards equity and this shifts due to market movements, either increasing or decreasing, rebalance your portfolio back to the desired allocation by adjusting the portion in your debt or hybrid funds. This way, you maintain your intended risk level without the need for constant oversight. On a conservative side, I would suggest that you withdraw 4 to 5% of your portfolio annually so that the corpus lasts very long. In other words, 4% withdrawal rate means your portfolio should be 25 times your annual expenses. So if your monthly expense is 50,000, your yearly expense is 6 lakhs. Therefore, your corpus should be 25 times larger. 25 times 6 lakhs, which is 1.5 crores. So with 1.5 crores, conservatively withdrawing 4% per annum, it works to rupees 50,000 a month. You may not run out of your initial corpus in this plan. It can last beyond you. That's financial freedom number that many experts speak about, 25 times your annual expenditure. To wrap up this video, here is an insightful story using an incident involving Amitabh Bachchan and London tie shop to highlight the importance of valuations when investing. Recently, Samir Arora, a well-known fund manager, shared a story on social media about a shopping experience of Amitabh Bachchan that he had in London. The legendary actor was shopping for ties, but the shopkeeper, assuming Bachchan couldn't afford them, advised against buying. In a dramatic turn, Bachchan bought not just one, but 10 ties. While the story is a great tale of proving someone wrong, it teaches us an important lesson. Just because you can afford something, it doesn't mean it's worth the price. In investing too, price doesn't always reflect value. This theme was echoed in another story shared by Abid Hassan, founder of Sensible. At an airport, a shopkeeper advised Hassan not to buy a watch priced at 25,000 rupees, assuming it was beyond his budget. Instead of feeling insulted, Hassan thanked him and walked away, realizing that sometimes it's wiser to avoid overpaying, even if you can afford it. There is a concept of sequence of returns risk, relevant for investors who are withdrawing regular income from their portfolio. This risk occurs when regular withdrawal aligns with poor market returns. This can erode the portfolio faster than anticipated. Imagine two investors, both with the same 50 lakh portfolio. If one experiences a market downturn as soon as he starts investing, his portfolio may not recover as quickly as someone who has seen growth in the initial years in his portfolio. Even if both portfolio generate the same average return over time, the one experiencing losses first could run out of funds sooner. To mitigate this strategy, like a more conservative withdrawal rate, using safer instruments like debt funds early or setting up a reserve for 2 to 3 years of living expenses in ultra-safe assets can provide flexibility during these market dips. The takeaway, whether it's a mutual fund or even a luxury item, just because something looks shiny or performs well in the short term, it does not mean it's a good long-term buy. Always assess the true value of investments and never chase prices. Sometimes walking away is the smartest decision you can make for your financial future. If you would like to have a report on the multi-asset funds, please email here. If you found value in this video, don't forget hitting the like button, subscribing to this channel, and sharing it with your friends who might benefit from this. I would also love to hear your thoughts. Drop your honest comments below and I'll be sure to read and respond to them.